if they missed the number. So I mean, they clearly just absolutely missed their own forecast. And look, anytime a company puts out a 50% growth target, it always comes back to bite them.
Today, folks, Zoom is getting destroyed. And because Zoom's getting destroyed after its earnings, it's taking Google with it. It's taking Facebook with it. And this morning, I decided to buy more Facebook at $322 a share, hoping this is the bottom, but probably not. I'm going to go over to you why I made this decision, but we all got to kick it off by talking about Snap here first, right? Because Snap is kind of the precursor to what happens with Google and Facebook's earnings, because they always post earnings first. And Snap stock gets hammered as Apple's privacy crackdown stings advertisers, basically, because we all knew that Apple is basically letting you opt out of targeted advertising, which means Facebook can't do those kind of premium targeted ads anymore. And clearly it's hit Snapchat. But the question we got to ask ourselves is, how hard has it hit Snapchat? I mean, this is something that I found really intriguing, because just reading the top of the article first, Snap stock was down more than 23% in early trading Friday morning after its earnings report sharply missed revenue expectations the day before. Why the big miss? Well, CEO Evan Spiegel said that Apple's recent privacy changes to iOS hampered advertisers' efforts to track their campaigns. But when we scroll down, they make it out like this was a big miss, like a huge, massive ordeal. But the company reported revenues for the quarter of $1.07 billion versus expectations of $1.1 billion. They missed by like a few little points here. I mean, nothing crazy. And the adjusted earnings per share were 0.17 versus expectations of 0.08. So they over doubled EPS expectations and just slightly missed on revenue. Is that such a shocker that the stock could be trading down? And I mean, just check this out. This is the craziest part. If you actually go into their earnings, that doesn't sound like bad news. Daily active users increased 23% year over year. Revenue increased 57% year over year. Net loss improved 64%. Read this, guys. Revenues increased 57%. You got net loss increase. All this stuff is great. The adjusted EBITDA improved 209%. Operating cash flow, guys, 72 million compared to 55 million in the year prior. Free cash flow, 52 million compared to 70 million in the year prior. So a little bit less free cash flow. But when I read this, I don't feel like that's bad news. I don't understand. I mean, I knew there was going to be some impairment charges, and I knew this was going to happen with Facebook. I knew that they've already been spouting that they're going to see probably some revenue misses here, folks. But when we scroll down and we take a look at the earnings consensus here for Facebook, they have beat every earning consensus by like 15 or 20% every time, sometimes by as much as like 30 to 40%. So even if they get an impairment charge by 15 or 20%, does that really make a big difference on a company that has a PE of 23 right now? And in fact, taking a look at this PE, the forward PE sits at 20. They got a forward PE of 20. To put that in perspective, Microsoft is hovering around a 40 PE right now. And that leads me to some curiosity about what is even Apple stock trading for at a PE right now. I mean, we're talking about almost 30. Facebook always remains the cheapest S&P top 10 stock. I think they have lots of room to take a breath if they do miss those earnings. And the coolest thing about this, guys, is if we take a look at the actual earnings consensus on this, Facebook right now has a strong buy and an average analyst price target of about $418 a share. That is an upside, guys, of $100 for every share you're buying right now. So what did I go ahead and do? Well, I went and picked up some more shares this morning, literally just before making this video at around $322 a share. I did end up picking up 3 shares, so right around $1,000 worth of Facebook, combining both of my accounts, because right now I'm only buying Facebook in my corporate account. I think I have around 47 shares in total. I'm going to be kind of jiffing around with these a little bit. I didn't want to buy more Facebook here, but I can't help myself. I primarily just use Facebook as a savings account. I figure if I plan on even selling some down the road, it's not going to be the biggest deal in the world, presuming that if I just put my money in there today, hopefully we kick inflation's ass. We end up back over $400 sometime in the next 6 to 12 months, and I certainly won't be complaining about the shares that I bought here. But I don't really understand why Snap is getting hit so hard. I didn't think this was the worst earnings report, and I want to pass that question off to you. What did you guys think about this in that comment section below? I know we got more news coming out of Facebook that they're changing their name. That was kind of funny. And then we also have some other news coming out with Trump's SPAC that's been flying through the moon, but I don't want to include that in this video, so maybe I'll talk about it a little later on. But let me know what you think. Stay cool, stay awesome, and I look forward to catching you in the next one.